I'd like to welcome all the participants today to today's seminar. Today's seminar is, I think, going to be a fun one. I'm Maureen O'Hara, for those of you who don't know me, and all I'm going to do is introduce our speaker. Our speaker is probably well known to many of you, but if not, should be. Gun Sear is a professor in computer science at Cornell, but at the last few years, he's been busy developing something called Avalanche and launching a currency called Avalanche and doing a lot of things that I think are really exciting. And they really point to a whole lot of areas that we as finance people and certainly CS people are really interesting, but it's hard for us to know about. So Gun is a co-author of mine. I'm delighted that he's going to speak with us today. So unlike many, the seminars, this is not a paper. This is really a talk about kind of what's out there right now. So like all seminars, Gun will be answering questions, and at the end, we'll particularly be answering questions. But if you have questions along the way, we can try and accommodate those. But I'm looking forward to it. Let me just say that, if you don't know about Gun, he's the director or co-director of the Initiative for Cryptocurrencies and Smart Contracts at Cornell, but which is actually more than Cornell. It's a global group, IC3. I'm happy to be part of it. He's known for having implemented the first currency that used proof of work to mint coins. His work on selfish mining is, anyone who writes papers knows about that one. Characterizing the scaling and centralization of existing cryptocurrencies, as well as having proposed leading protocols for on-chain and off-chain scaling. He's really been doing exciting things, and today I'm sure he's going to be talking to us in part about new ways to form consensus protocols, which is fundamental to some of the things he's been working on. So I'm going to get out of the way. Gun, take it away. If you can share your screen. Thank you so much for joining us.
Thank you so much, Maureen. Thank you very much for having me, and thank you all for your time. So what I want to do today is share with you a computer scientist turned CEO's perspective on DeFi and where we are in general with blockchains, where we are with decentralized finance, what exactly constitutes decentralized finance, and generally chat about the trends in this space from an academic that recently went into the trenches and has some kind of a recent grasp of this space. So let's maybe get started by talking about the big picture. I want to just provide a general framework. I want to spend at least half my time in Q&A. So I want to just briefly set the stage here. And so blockchains today. What's going on? What's really the big picture? So what I think is happening, at least from my perspective, is a fundamental shift in the way we construct computer systems. Until recently, we used to build what we call client-server systems. In a client-server system, you have clients that are powerless, and you have servers that provide all of the service, are owned by one entity, and that entity is fully in charge of the service provided to the clients. The best example of a client-server system would be Facebook, Google, etc. So in these systems, Facebook owns the machines, operates them. It is the entire determinant of exactly what happens with your data. And you as a client are just essentially kind of like a serf in the Middle Ages. You give your data to these services, they do whatever they like, and then they provide a little bit of service that you need. And in return, they are unchecked. They can do whatever they like in the back end. So what we are seeing with blockchains is the emergence of a new architecture where there is no single entity in charge. There is no singular backend. There is no singular set of machines that provides a service. There is no single entity that is in charge of what will happen to your information, to your service, and so on. Instead, the service is provided in a peer-to-peer fashion, in a collaborative fashion, by sets of people who come together to build a system. So this turns on its head the entire idea of how we knew how to build systems, right? So if Until 2010, if you were to sit down and build anything, the only paradigm available to you was client server. And now we're seeing that, hey, it's actually possible to build something really, really big, really, really valuable, where nobody is in charge. That's very different. So this is deeply disruptive. Deeply, deeply disruptive. It is my opinion that, or at least my observation, that every time you have a new technological capability, there are billion-dollar companies that are formed. And it's also a simple observation, if you look back, that every time you apply information technology and new innovations there to a different domain, you get, again, billion-dollar efforts, a lot of efficiencies, a lot of new value being created. And if I look back, to the finance field, obviously that is your field, you know it better than I do, far, far better than I do. But from an outside perspective, take retail banking. It's an area that has not changed much. It has not changed qualitatively since 1954 or so, right? Yeah, once the credit card boom happened, afterwards, whatever else happened is just, essentially there was some automation, but there was no rethinking of how that could be provided. And that is true for various different aspects of finance. And if we look at what's happening with blockchains, it is deeply disruptive. If you take IT technology and apply it to a prosaic area, hailing cabs or renting out hotels and so forth, you get billion-dollar unicorns. Well, if you take IT technology and apply it to finance broadly, then you get an enormous explosion of lots and lots of people who are very excited about this new architecture and what it means for the kinds of systems we can build. So one of the emergent things here is borderless user-centric economies. The notion of jurisdiction, the notion of vertically stovepiped systems goes out the door. And instead you have global reach. Suddenly, anybody anywhere, you could be in Kansas and you could start selling a digital asset to people in Singapore, to people in China, to people in North Korea, etc., including the last one. And that's where some of the dangers come in. So this means that it's individuals, not institutions, in control, potentially. It means that it's a flat, fair playing field, potentially. So of course it could get captured, but there is a promise there. And I personally believe that there's an extinction level event coming for a lot of incumbents. The incumbents that are unable to change and adopt blockchains are going to be obliterated. And at the same time, there's going to be a lot of, there are already a lot of opportunities for startups to flourish with this new technology. So I think if you look at the market growth, the area has become really big. Bitcoin itself crossed the 1 trillion market cap boundary. We're, I think, about $2 trillion in the crypto space. Now, I think to laymen like me, these numbers seem big. This is still kind of early, right? You all realize that these numbers get really big, really fast in the global scheme of things, and 2 trillion is sizable. It means that there's something here, I think, but it's still in the very, very early stages of growing and potentially and hopefully taking over the world. Let's see. So there's a lot of innovation going on. I want to talk to you a little bit about the tech foundations and sort of provide a little bit of framework for what's happening underneath, because there are fundamental challenges we must overcome for this technology to prove its worth, right? So it's not sufficient to just show that you can transfer value. You need to be able to do it at volumes, at scale, that is required by finance. And so therein lies a huge problem. And of course, there are a bunch of other challenges. I want to talk about them in a second. And of course, there's a lot of adoption. There's Visa, there's PayPal, there's Facebook testifying in front of Congress, which, by the way, they're doing something interesting. The system that they're using, the core protocol behind it, was co-authored by one of my students, and it's kind of fun. Like, I sent him over to the West Coast for a summer. He came back. He said, "Oh, hey, this is really cool stuff. I built something neat, but I want to work on something even cooler, Avalanche." And he now is working with me. But the stuff he did before then is what Facebook took off with and tried to build their currency around. So everybody, of course, in the Fortune 500 has done a proof of concept with a permissioned blockchain. I'm sure all of you have heard of these various efforts. We know of only one of them that has actually been deployed. So there have been many, many, many false starts. So it would be unfair to say that this is all, roses and great stuff. It's not. It's there have been many false starts in this technology. There are ways of deploying this that don't provide the value, that don't achieve the potential promise. And it's interesting. I'm happy to talk about why that might be and what the impediments are to success here. But in my opinion, I would say of the Fortune 500, 495 or more have done a proof of concept. So every single big company has experimented with blockchains already, and there's a lot of excitement. So let's see, what are the challenges here? There are a lot of big issues related to trust, to regulatory clarity, and to user experience. So decentralized systems, they foster trustless interactions between peers, but adoption is contingent on gaining trust from the public. And the public doesn't necessarily have the right framework for dealing with decentralized systems. And in some cases, they prefer the presence of a trusted entity. And that's kind of interesting sometimes. And happy to expand on what this means. But for these systems to gain acceptance in the market, there needs to be typically some amount of time for them to just sit there and gel, for them to sit there and demonstrate that they are actually, not going away, not getting hacked, not doing, whatever, engaging in malfeasance or whatever else might happen to them. So they just have to prove their worth just by virtue of passage of time and user education, and that's one of the issues with this space. Those of you who've ever tried to do anything in the space know that regulatory clarity is severely lacking. I have to say that the regulators have been extremely, extremely accommodating in the West. So both in the US and in the European Union, they've taken a light touch to the blockchain area. They've tried to foster innovation, and I'm genuinely grateful as somebody in this area. And I have counseled them to do this myself as well. In other countries, this is not so. Both India, China, and Russia have followed a different curve. And the curve has sometimes gone, typically has gone up and to the right. So adoption has increased over time. But there have been setbacks. Sometimes they ban blockchain technologies, or they try to ban different aspects of blockchains. They try to ban on-ramps to blockchains and so forth. So we need regulatory clarity. The funny thing, of course, is these bans don't really work. Right? So at the end of the day, these are permissionless technologies. They cannot be shut down. They've been designed not to be shut down easily. So the regulators who've tried to ban them have generally ended up looking silly. And that's why I say that the general trend is up and to the right. So they try to ban, they try to slow things down. And then of course, what happens is they have to walk it back. But regulatory clarity, especially in the US with its federal structure and various different entities that regulate the same kinds of assets, is fractured and confusing. So we need clarity, and that's one of the issues in this space. The user experience is beyond clunky. So if any of you after this talk or have already tried maybe to interact with DeFi applications, you will find that you have to engage in very, very complicated maneuvers. It takes, 15 steps, for example, to engage in an arbitrage between two different market makers. This is common now, and I'll share with you some terminology. The people who navigate this typically tend to be supremely tech savvy. They themselves continually complain about how complicated it is, these are called degens, so it's short for degenerate. So they kind of go in and out of these contracts very, very fast, trying to take advantage of money-making opportunities between various services that manage valuable assets. But the user experience overall is nowhere near, absolutely nowhere near what you would experience if you went to Charles Schwab or Robinhood or whatever. So there's a huge gap there, and that's something that we need to cross. So what are the opportunities ahead of us? So again, at a very, very high level, what's really going on? We are going from traditional assets to programmable assets. So we're going from financial assets that are passive objects. These are typically, these days, like automation has been applied to finance, as you well know. These are digital objects already. So digitization isn't exactly new, but these are passive. And there is a gatekeeper, there's a custodian typically who keeps track of and holds your valuable digital asset, records it on a database. That database represents ownership. It's siloed. So I challenge you to go and purchase, as I tried to do in upstate New York, to buy some Putin-issued Russian state bonds. Okay, this is not a complicated financial asset. It's a bond. These things have been around for hundreds of years, and it's being issued by a sovereign entity, Russia. And at the time I tried to do this, Putin was offering, I think, 13% interest. My bank was offering 3% interest. So I went to my bank and I said, I would like to buy some of these Russian bonds. And what ensued was a hilarious thing. I said, well, you have to talk to our investment advisor. Okay, I said, okay. Investment advisor comes in on Tuesdays and Thursdays. It's upstate New York. And I went up to him, I described what I wanted to do. He looked at me and said, oh, it looks like you want to buy some junk bonds. And I said, no, I want to buy sovereign bonds. And he said, well, can I interest you in GM? I said, no, GM builds coffins and Putin puts people in coffins. But the short story is these assets, there are many assets in the world, traditional assets, that you just cannot access. I ended up not being able to buy and take advantage of 13% interest from Russia. And instead, I had to just deal with the 3% from my bank. And had I bought GM, then you know what happened afterwards. They had to be bailed out. So let's see. And then everything about this world, in the traditional finance world, relies on manual compliance and post-facto audits. So if there is something bad happening, well, then that is discovered after the fact. Then there is punishments and so forth levied in the bad actors. How often does this happen? Fairly darn often, I would say. Again, as an outsider looking in, every half a decade, there is a big scandal of some kind. The latest one I can point out easily is the Dole company. And those of you who followed this issue, it didn't really get that much play. But Dole company issued 38 million shares. And as you know, the market does shut down after price moves. And when it does shut down, there are people who allow these shares to be traded even when the main markets are closed, and then they reconcile. But during that reconciliation process, there were errors, and there were 53 million claims to Dole company's shares, even though there were only 38 million shares. So in effect, there were 53 million people who thought they owned these shares. And so that is a huge, huge failing. Okay, so yes, we have a great system. Yes, it generally works, but does it even do the most basic things it's supposed to do? No, it doesn't. And it's very hard for it to do this because the ad hoc post-facto compliance and checking is actually very difficult to get right. Now, what's the promise of programmable assets? Well, what they have is that what they provide programmatic ownership. They're stored in an interoperable, flat, open network. Anybody from anywhere can purchase these things. There are no silos. This is at once a blessing and, of course, a curse, because now your competition is everybody. Anybody who's anywhere can launch attacks on your systems and on your smart contracts and so forth. And one of the most exciting things, at least for me, is that compliance, enforcement, and so on is programmatic. You can build something into a smart contract that is incontrovertible. And once you build that in, then you don't have to check for it because the system won't let you violate that invariant. So if you say that the max number of assets is 38 million, well, then that's what it is. You don't have to check it. You don't have to go do a big summation or whatever else. You don't have to do a giant systemic audit because the system would never have allowed it to be 38 million one in the first place. And there are many other much more nuanced versions of invariants people might want to enforce that are enforceable via smart contracts. So this is a brand new world. We can do new things that we could never do in the old world. You can build services into programmatic assets. When so much money comes in, it's divided in the following, 80% goes to Professor O'Hara and 20% comes to me. Okay, we wrote something together and she gets 80%. We wrote a book together, she gets 80% of the royalties, I get 20%. That kind of division can be done with the aid of what is known as a smart contract, a piece of code that determines how value flows, how money flows. So that takes away the human element that codifies once and for all time how that value is going to be divided and processed. And that is an incredibly calming thing, if you ask me, because you can rest easy knowing that that piece of functionality is incontrovertible. It's been built into the system. That's what's going to be processing the money, and that division is going to be happening exactly as we know it will. So this, of course, isn't as easy as I make it sound up here. It means that both Maureen and I have to inspect the code, et cetera, a whole bunch of things we can talk about in practice. But there is a promise there that isn't there when you are dealing with traditional assets. We don't need a manager. We don't need a middleman. And that disintermediation is at the heart of this whole disruption. So let's see. So we can automate an enormous number of functionality. So things like stock splits, lockup periods, right of first refusals, regulations, or coupon payments, dividend distributions, all of these things that you're familiar from traditional finance, we can just build them in to these systems at a very low level in such a way as to make them incontrovertible. So you cannot buy this item unless you've been KYC AML, then you have a credential in your hand to show that you've been through that process. Done. Okay, so we don't need to go and audit all of your KYC AML logs. And I can go on like this for any of these things. And this allows us to streamline business processes. So again, let me just do my one last grandstanding kind of claim. And but I think this is true, right? That if I look back at the history of mankind, there are a couple of things that sort of stick out, right? So you have, I don't know, whatever it was that we had many, many tens of thousands of years ago, where like anything goes. You have the rise of law, right? So that is a big, big event, and it changes things, right? Once you are living in a state with, proper laws, you can sleep well at night knowing what will and will not happen to you. You have the rise of, this is much more recent, rise of fictional entities. You have the rise of corporations, virtual entities. And so that suddenly means that there is an entity that is not a person, but is a corporation that is going to take over a task. And now we have, with smart contracts, we have the ability to take corporate-like structures, take their business processes and encode them on a blockchain such that everybody can know what exactly that contract, that virtual corporation, if you will go ahead and do. And that is a deeply disruptive thing, because suddenly you can, again, sleep well at night knowing what's going to happen. You can encode, you can provide assurance, you can provide that trust that's necessary for people to say, hey, yes, I understand what's going on here, and I'm happy to use this thing. And this is with nobody in charge. So I want to now delve a little bit deeper into what's underneath blockchains and talk to you a little bit about my area of expertise, which is the actual underlying technology. I'm not going to take too long on this, but I want to give you the right framework for how to think about what's happening at the tech side of this. So there are really, if you ask me, three main problems that we needed to overcome. I think in 2009, Satoshi Nakamoto came up with a brilliant idea, and he demonstrated with Bitcoin that these technologies were mature enough to create highly valuable assets, and that these highly valuable assets can have a life of their own. In the time that Bitcoin has been around, since 2010, that's 11 years. I personally know at least half a dozen instances where Amazon Web Services went down. I have no idea how many people are on the team that is around to make sure that those services remain up. But if that number is less than 100, there's no way that number is less than 100. So you've got hundreds of people rushing to keep AWS up, and yet it has had at least half a dozen failures. I know of at least a handful of cases where Google services went down. And in those 11 years, Bitcoin never did. And one of the core things about this technology is because it's decentralized, because it's comprised of a whole lot of people coming together to provide a service, it tends to be very, very resilient. So sure, there are unintended bugs in the code, and then you can have networks, experience difficulties and so forth. That has happened. But in general, it's possible to build these services in a way that they can withstand enormous amounts of disruption. So that's fantastic. What is difficult, though, with these systems is threefold. There are three big challenges that, despite Bitcoin's success, we have always faced. Now, what are those challenges? Number one is scale and performance. These systems that we have don't scale. They certainly do not scale to the level that you all are used to or would like to see. So what does that mean? So Bitcoin, for example, the layer 1 of Bitcoin, the lowest layer, handles about 3 to 7 transactions per second. So if, so people talk a lot about Bitcoin replacing the dollar or gold. In the old days, we used to talk about Bitcoin being used for payments. So if people try to use Bitcoin for payments, and the nation of, let's say, Venezuela tried to use Bitcoin for payments, every adult would be able to go to the grocery store once every 36 days. Okay, so that's just if only Venezuela converted, they can only do one transaction. One person gets to do one transaction every 36 days. So clearly, the core technology here is incapable of, or was incapable of scaling. That was a big, big problem. There are other performance metrics besides scale. There is latency. So latency is the time from the moment where a transaction is issued to the time when it's finalized. And for Bitcoin, that latency is on average about an hour. So I do a payment, and it takes an hour for that payment to be finalized. So again, in the old days, when people tried to pay at a restaurant with Bitcoin, they would have to sit there and wait for the transaction to be mined, to be incorporated into the blockchain, and it would take potentially a long, long time. It's on average 60 minutes, and sometimes there are gaps. Sometimes it takes far longer. There are other funny stories where people would, if you were trying to buy Bitcoin from a person directly, what you do is you used to meet them at a parking lot in front of a police station. You get into a car, it's a very, very suspect seeming thing, and you give them your money, but you can't, they can't just walk away. You need to see their transaction mined, so you sit awkwardly in the car, I guess, for an hour, waiting for your transaction to become finalized. These are not the markers of a system that's going to threaten the NASDAQ anytime soon. Okay, so if we're going to reimagine finance, if we're going to reimagine Wall Street using a different back end, then we need to solve the scale problem. We needed to address this. And so that's one. The second, of course, is usability. And one of the biggest issues with this space is that there are many different coins. There may be like 6,000 digital assets that people have generated. And all of them tend to offer the same lowest common denominator service. Okay, so they just are like, okay, I've seen Satoshi succeed, I've made a copy of what he built. That's essentially what they do, because everybody does this. And the vision is always identical. It's like, let me create a coin, let me create a system that implements the characteristics of that coin, which I've copied from Bitcoin. Typically, that's what people do. And then let's build a single network that handles that coin. So you've got Bitcoin, we got Bitcoin script, which is the scripting language that determines how Bitcoins move. And then you've got the Bitcoin network, and that network implements the Bitcoin scripting language and maintains Bitcoin ownership. So that's what they had. And everybody then copied this general structure. What we did not have is an ability to handle multiple jurisdictions, is an ability to handle multiple different assets with different behaviors. And that has been, I believe, one of the main issues that we faced. That is, we had networks that only had one asset, one scripting language, one network. And that network, that whole thing is a one-size-fits-all. That Bitcoin has only its own laws and rules, and it's sort of like I don't know, supra-state or whatever. It's above the state level. It's just, it is what it is, and it pays no attention to what's underneath or above it. It just does whatever it's been programmed to do. And this is fine for some of the things it's doing, but when you go to, when you talk to enterprises that have their own digital assets that they want to issue, you will find that they want to control certain aspects of the behavior of the system. And this one-size-fits-all does not provide that to them. Happy to go into this later on as well. So that's an area that I think that we're seeing in the last couple of years that people are addressing, including my own work. And the final thing, of course, is governance and adaptability. The issue here is, so these blockchains, you've got the chain itself, you've got the rules that are associated with it, and typically when nobody is in charge, what you end up doing is you end up encoding the rules into the underlying software. And once you do that, it becomes very, very difficult to change them. There's nobody in charge who's supposed to have a say in changing them. So for example, the best example of this is the coin minting schedule of Bitcoin. So Satoshi, when he came up with the code in 2009, 2010, he fixed for all time the rate at which Bitcoins are going to be issued. It's a curve kind of like this. And he just made it up. And, often he got it right. He got very lucky. And but sometimes he overminted and sometimes he undermints, right? And when he undermints, it's okay. The price goes up. Everybody's happy. But when he overmints, the price crashes. And many other people who copied this. So Zcash copied the exact same curve. And Zcash is completely, or was until recently, they changed it. Until recently, Zcash was completely overminting because they just copied this curve and it doesn't work for them. So what you need to do in any economic system, as you very well know, is you need to adapt to changing external market conditions. So and that is at odds with fixing things in code. So what you typically need is a way to govern, a way for your system to adapt to changing external market conditions. And that is also something that at least the first and second generation of blockchains out there do not address. And that is something that's absolutely essential for people to take deployment to the next level. So when I say first generation, second generation, let me give you some rough ideas. So Bitcoin is obviously first generation. It's the very first of these coins that was successful. There was history before Bitcoin as well, but Bitcoin was the very first one that really succeeded because it had this brilliant breakthrough by Satoshi Nakamoto. Other coins you might have heard of, Litecoin, Zcash, etc. These are all, Litecoin is just a copycat of Bitcoin. There's almost no difference. Zcash adds privacy. These are all first generation protocols. Second generation protocols like Ethereum came in and they provided the ability to program the behavior of the coin. So whereas Bitcoin is Bitcoin script and it's very limited what you can do with it, Ethereum gives you the ability to write code, to write smart contracts. And that's a wonderful big step. And there are now third generation protocols that are here to create a fully digital economy. And they have a different vision, a broader vision that addresses performance, that addresses flexibility, usability, and that addresses governance as well. So an Avalanche is the system I worked on, and I'm still currently working on, that has these features. And there are many, many copycats of second generation protocols. You'll see a whole lot of people with a whole lot of claims. Many of these claims are absolutely false. Almost, some of them are fraudulently false. And it's just what they're doing is they're going back in time to very old systems and resurrecting very old discarded ideas to try to come up with some claim to novelty. So again, very quickly, let me tell you a little bit about sort of the technology. So my area of distributed systems has only been around for 45 years. So it's a brand new area. It's not like economics. It goes back, hundreds of years. My area goes back just, 45 years. In those 45 years, very, very early on, people realized that consensus is an absolutely fundamental operation. Right? So when you go to google.com or Gmail or whatever, you need to get directed to the set of hosts that hold your email. There's a set of hosts that hold your email. They need to hold the same emails. When you read one, they all have to mark it as read and so on. That's a consensus problem. Specifically, consensus, the problem itself is making sure that a set of nodes maintains the exact same series of operations to the same data. So we need to decide, Professor Sira read this message, got this message, or got this payment, and he spent so much of it here. That has to be a totally ordered sequence on which none of the nodes disagree, or rather, all of the nodes agree on exactly the same sequence. So that's the consensus. They have to agree. A consensus is just obvious from the name. This problem is actually far deeper and kind of hard, kind of much harder than what you might imagine. There are lots and lots of things that can go wrong with any kind of a simplistic approach. Until today, until recently rather, until 2 years ago, we had only two approaches to consensus. One of them was what we call classical consensus. Okay, so classical consensus started out in, the problem got mentioned in the late 70s in an informal way, got formalized in the 80s, got solved fairly well in the 90s. And almost every proof of stake protocol, if you've ever heard of that term, is essentially trying to resurrect one of the protocols from the 1990s. So these protocols were very well known. These protocols are, they've been around, as I said, for many, many years. My student worked on one of them that later became Facebook's Libra effort. And this is all research that we all knew about. Satoshi knew about this. And Satoshi discarded this research. He said, this is not acceptable because it doesn't scale beyond a few hundred validators. These systems all work by having a set of delegates vote on what happened. So typically you designate some people to be kind of like your senators, if you will, and the Senate then says this happened and this happened and this happened. Okay? And the problem, of course, is once you have a set of senators, they will essentially keep other people out. They now won't let new senators in. They will let their friends in. They might censor. It becomes a closed system. And so Satoshi, looking at this, said, this is not suitable. He had full access, 10 years of it actually, to the then best protocol in 2009. He knew all about these protocols and said, these are not suitable. And yet what we have now are people are realizing that the performance problem is really hard to address. And classical consensus protocols are actually fairly good at performance, especially at latency. They can be very good at latency. So they're resurrecting these protocols, but they're giving up on the one thing that makes this area exciting, which is that it's open. So that is, I think, what's going on at the moment with most of the efforts in this space. They're going back to the 90s to resurrect old protocols based on classical consensus. These protocols are also very, very fragile. They use lots and lots of very complicated mechanisms, and they end up getting centralized. So that's, as I said, that takes away the main value proposition of these protocols. So Nakamoto, Satoshi, when he came around, he looked around and he said, look, these old protocols don't work. Let me show you something else that you can do. And he came up with his idea based on mining. And now the mining idea, which Maureen tells me everybody's familiar with how this works, but the mining idea is fine, but it's slow and limited capacity. Right, so I just mentioned that Bitcoin is somewhere between 3 to 7 transactions per second. It's very, very slow. The confirmation times are incredibly long. And these tend to be centralized. So if I look at Bitcoin, there are about 24 mining pools. Most of them are in China. And there was once a conference where all the miners got together. So on stage, you had like 99% of the hash power behind Bitcoin. So if you issued subpoenas to those people, or if you issued an injunction or an order to those people, they would then be able to rewrite the Bitcoin blockchain to fit whatever you wanted. And there's only a handful of them. Law enforcement is perfectly capable of sending letters to a handful of people. And of course, it's incredibly wasteful. The amount of energy that goes into cryptocurrency mining was at one point somewhere between 1 to 2% of our global electricity production. So think about that for a second. 1 to 2% is enormous amounts of energy. This energy is not going into processing transactions. So you all are used to systems like NASDAQ, et cetera, where the more machines you have, the faster, the more you can do. That is not so when it comes to Nakamoto consensus. The hash power is used to keep other miners at bay, and the rate at which the protocol processes transactions is fixed by the protocol. Bitcoin will not do more than 3 to 7 transactions per second. It's designed into it. It will always issue it will always issue 1 block every 10 minutes. That's just how it's self-pacing. So the more machinery you have, the more of the mining pie that you own, but it's not the case that the system is getting faster. So these systems are incredibly wasteful. They consume more energy than Austria, more energy than Sweden. These are giant industrial economies with millions of people living in them, and we're using that much energy to simply maintain an ordered record. Now, let's be fair, until recently, this was the only way I knew that one could do this in a decentralized fashion. So this was the best technology. But now we have one additional new approach. There's a new protocol family called Avalanche that has a very different approach. It's a leaderless approach. It uses a different mechanism at heart called metastability. And it does not resort to mining. There's absolutely no mining in Avalanche. It does not resort to sortition. It does not resort to selecting a small senate, a set of delegates. Instead, everybody can be part of the network. It's open, so it fixes that problem with classical protocols. And like classical protocols, it's incredibly robust, it's incredibly performant, it's incredibly inclusive. So it's very, very low latency. Avalanche today finalizes, not just processes, finalizes a transaction in about 1 second. So in the blink of an eye, a transaction is incontrovertible, it's done, it's immutable, it's been committed to a blockchain. That is many, many, many orders of magnitude faster than competitors. It can handle transactions that are much faster than I thought I would see in my lifetime. So Avalanche today is 3 times faster than Visa. So Visa does, on an average day, it does 1,700 transactions per second, and Avalanche can do, in at least the test that we did for 4,500 is the number we're advertising. We've done tests where we've even our prototype code was achieving 20,000 transactions per second and above. So these are really large numbers. There are maybe even larger numbers out there, but they're measured in a funny way. These are actually properly measured numbers that one can achieve. It's also robust. It's resilient to attacks from attackers that own more than 51% of the stake. So that's a very odd feature. I'm happy to go into it if we have time. I'm talking a little too much, so I'll speed up a little bit. So it's capable of supporting up to millions of participants in the protocol. So that is something that nobody else can say. So that is not true. There aren't millions of participants to the Bitcoin mining game, and certainly not millions of participants to any of the other proof of stake protocols. They're just not capable of handling more than 100 participants. And it's efficient and green. We're not melting the poles. We're not depriving the polar bears of their habitat. It's just a very fast protocol. So does things entirely differently. The operation of the protocol, etc., that's really more designed for a computer science audience. I'm happy to talk about the differences, but just at a very high level, classical is kind of like, as I said, senators in a Senate. You have to elect them, and then they sit there, they make decisions. It's good for low latency, high throughput, etc., but it's not very robust. It's definitely not decentralized. It definitely doesn't scale. Nakamoto is very robust. And the way I think of Nakamoto is kind of like the lottery. You know, you scratch, you win, and if you're the winning miner, then you determine the next page of the blockchain. So that's fine. That's how it works. Avalanche is more like a giant stadium of people all organizing to pick one color over another. And so there's an emergent consensus decision that comes out of this process, and it happens to have the best of both worlds. It's robust like Nakamoto, it's performant like classical, and it's resilient to 51% attacks like no other. So that's a very nice situation to be in.
Hey, Gun, just 1 second here. There are a couple of questions.
Sure.
But you have about 15 more minutes if you want to talk and then open it up for questions, or you can take questions now. Would you
Take them
prefer
now.
to get through it and then do them all in the question and answer session? What would you prefer?
Maybe take them now. Let's take the questions now. I'd love to do that.
Okay, well, I think David Yermak, hang on one second, had a question, and I'm going to have to unmute him. So let me do that. Oops, how am I going to allow? There we go. So David, and you should be able to ask your question. And I'm not sure I'm hearing David.
Maureen, I think this was a mistake.
Oh, okay. David, if you don't want to have a question, that's fine. Is there anyone else out there who had a question? Excellent. Then Gunn, it's back to you.
Okay, let me just go through, I don't have all that much left. So let me go and talk a little bit about decentralized finance. So this was my computer science background on what's happening underneath the covers with these systems, and how there are three different approaches, and how this new breakthrough in the last 2 years represents a completely new approach to the consensus problem. And so this allows us to solve the decentralization and the performance issues I mentioned. In addition to all this, Avalanche has a couple of other features I did not mention. One of them is the ability to build sub-networks. So on let's say Bitcoin, you only have one network, as I mentioned. On Avalanche, you can have sub-networks. So you could create a sub-network for the EU where the nodes promise to uphold GDPR rules. Or you can build a sub-network for India where the nodes are all on Indian territory under Indian jurisdiction and Indian law, and so on and so forth. Or you can build sub-networks where all the nodes have lots and lots of resources, so you can run your network with parameters that are much higher than you would if you were on an open network for the general public. So these are all things that one can do with Avalanche that allow the network to be customized to different kinds of assets. You can run different virtual machines on Avalanche on each subnetwork. So you can say, hey, I'm not going to be using the Avalanche virtual machine. That's not sufficient for my assets, which have a funky way of behaving. For example, fractionalized real estate. Assets can be merged and divided. So I'm going to build my own virtual machine to support this. And that is something that Avalanche can do that Bitcoin and other single asset networks cannot do. So, and then of course, Avalanche has governance that allow the participants in the system to determine key parameters of the system. So as the economic realities change externally, then you can change the reward rates in the system so as to attract more stakers, more participants into the network. So, so those are the three ways in which Avalanche addresses those three challenges, and I just want to mention and put it in context with regard to other work that came before us. Now, what does this do? Well, this opens up a new playing field, and there's a new game in town called decentralized finance, and I want to talk about this a little bit. There is an emerging, burgeoning area of entirely new applications. Some of them are, I would say, just, crossover from traditional finance into blockchains. But some of them are brand new, specific to this space, taking advantage of the unique features of the underlying blockchain. Talk about that in a second. But we're seeing, I would say, about 9 or 10 different areas. I'm sure all of you have heard of stable coins. So now there are coins that represent $1. There are coins that represent euros. There are coins that represent diamonds. And other things. And so that's an interesting area where suddenly you no longer need to use a volatile asset for your financial transactions. And interestingly, some of these stable coins are backed by dollars. And these are called fiat-pegged stable coins. And some of them are algorithmic, where there's a digital asset and the value of that asset is kept pegged to $1 by virtue of an algorithmic game. And this area is incredibly understudied, and it's amazing how well some of these protocols have been able to work. It's certainly an area that requires a lot of scrutiny and a lot of interesting academic work. There are interesting insurance products that are being sold. Insurance is essentially a game of bringing in claimants with financiers, and portions of the middle business flow can be overtaken by a blockchain, providing some efficiency there. There are all kinds of derivatives, perpetual swaps, etc., that people place and people create. There are lots and lots of synthetic things, synthetic assets that correspond, kind of like a stable coin does, to value in the real world. So that's an interesting area. There are a lot of interesting borrowing applications. I want to talk about this for a second at some point. Nowhere else can you or I go and borrow $1 billion, unless some of you are billionaires, I guess you could. But it's very difficult. And I think a lot of people know about the George Soros arbitrage trade from the 90s, early 90s, where he borrowed many billions of dollars and went around in a circle between 3 central banks. You could do that right now. You can borrow literally $1 billion for about a microsecond or so, but for about a millisecond or so. And the underlying system ensures that you will return it. And what you can do is you can borrow $1 billion, engage in some arbitrage, and if the arbitrage goes your way, then you keep the proceeds. And if it doesn't, then you just cancel your transaction. You're out some fees, and you return. But in either case, you return the $1 billion. The $1 billion that you borrowed. And it's an amazing thing that this area, this is called flash loans. You only have it for a flashing instant, about a millisecond or so. And it allows people to do arbitrage on these blockchains at a rate that is unprecedented anywhere else. Just, regular old high school students are doing these kinds of trades and making huge sums of money. There are trading platforms, there are decentralized exchanges. So instead of going to NASDAQ, or going to whatever it is, like a front end to NASDAQ, you can go directly to these decentralized exchanges and you can trade any asset and no one can stop you. This has lots of implications for regulators. So they at least cannot, no one can stop what happens on the chain. Right? It's just trying to regulate that is impossible. So it's a very interesting world out there. And so I'm not going to go, let me not spend too much time here. Let's look at the big picture. There are unprecedented macroeconomic things happening that have caused people to turn to DeFi. So national economies have shut down in many different countries, especially outside the first world. It's just the pandemic has been an absolute devastation on many, many people. There's astronomical amounts of debt, both by sovereigns and people as well. And inflation worries, bank runs, or haircuts these are very real worries for many people around the world. And so people are looking for an asset class that cannot be seized by anyone else. And blockchains come in right here. So there's a lot of mistrust in centralized systems. I'm not going to mention the whole, Wall Street bets versus Robinhood, the GameStop debacle. But people don't trust centralized systems anymore. They're slowly beginning to learn that when there is a centralized system, then there's somebody out there that can actually take unilateral action and take advantage of them. And so now with the pandemic and people having more time on their hands, maybe, or more opportunities to look around elsewhere, and motivation to look at better yielding instruments, people have been turning towards this new universe. And total value locked in DeFi is growing immensely. This is just the last, whatever it is, I think about the last year or so. And you can see that the amount of value locked in decentralized finance protocols is on the order of tens of billions. So we're very, very, very early. New ideas are still coming up. Many of them are poorly understood. So some of these algorithmic stablecoins are actually stable, empirically speaking. Many of them have absolutely no reason for why they should be stable. So some of them are probably flawed, and we will probably have some really, really big crashes. On the other hand, the entire economy here has been growing incredibly well. So there's something here that intelligent people need to come in and characterize and understand. Let's see. Let me just mention these items. So code is buggy. We know this. People lose a lot of money to hacks. People lose a lot of money to malfeasance, to essentially malfeasance done with the aid of a blockchain. Malfeasance, like frauds, typically these are called rug pulls sometimes. So you build a smart contract, you attract a lot of money into it, but there's a flaw that you placed into the contract, which you then use to drain the contract and take people's money. So we go from having to trust one entity now to having to trust the code, but most people don't know how to evaluate the code, and therefore you get into these situations where people lose their savings, and it's an absolute, it's just heartbreaking to watch. There are scams, and scams are fairly common, just like every single gold rush. With these kinds of things attract a certain kind of person. And it's very difficult to find the actual authorities or the actual entities that are the counterparty to what you are doing. So when you do lose your money, what do you do? Right? Who do you complain to? With traditional finance, you can on occasion undo trades. Right? You can undo at least credit card payments, for example, right? So there's a baked into the system. Many of these protocols are dealing with bearer instruments. The moment you lose the bearer instrument, it's gone forever. And then the user experience, I mentioned this, it's really a mess. So at the moment, it's very, very, very hard for most people to use. I'm amazed that it has flourished to the extent it has. And I can't imagine what will happen when it becomes easier to use. Finally, I'm sure you've heard of non-fungible tokens recently. These things are really famous, and they got a lot of traction recently. So people are placing digital art on blockchains and selling the rights to that digital art. It's a very funny world. These are kind of like collectibles. These are different kind of a digital asset. So there's a lot of confusion around NFTs. The word NFT means non-fungible token. One person paid $69 million for a single NFT. It's just a card you hold. Now, the confusion here is typically that people think they're buying the art, that when I buy this little thing here, like whatever this is, picture of a door, I guess, that it's mine. It's not. Anybody can right-click on it. Anybody can save it. I'm not buying anything that's exclusive, etc. What I am buying, though, is an official entry made by the artist. So it is, and it can confer to me rights and things, abilities that other people do not have. So that's an interesting thing to be able to do. This area has flourished a lot in the last month. Happy to talk about what it means. These are assets that are one of a kind, whereas Bitcoins are fungible. These are not. And these things date back to I don't know, maybe 5-6 years. And they just became a very big area. They're growing, and it's we're going to find that they actually can be used for good things or interesting things, other than just ownership of little collectible items. They're kind of like trading cards at the moment. That always fascinates people. But what they really could be is they could actually function as credentials, and so that's where I think I'm really excited about them. And there are uses for NFTs in DeFi and other places. Where they can serve as a key, as a credential that allows somebody to do something.
Hey, Gun, if you could, turn to question and answer pretty soon. Okay.
So let me just finish. This is my last slide. The NFTs are growing a lot. And yeah, so NFTs are really, really nice in the sense that all of the transactions are trackable on the blockchain, and the original artist can make a lot of money. So I want to stop here and just start taking questions and on any aspect of what I mentioned, either blockchains, the underlying technology, or DeFi and NFTs.
So, Gun, I know that Larry Wall had a question. I'm trying to find him here so I can unmute him in the question and answer. Larry, I don't know if you're still here. There you are. Larry, I've allowed you to talk. Can you ask your question?
Okay. A system that's open to everyone without any moderation, as you were kind of talking about at the end, is open to every bad actor and every bad practice ever seen in finance. So one approach to solving this is a pure user beware approach that puts all the costs on individual users. But that's going to be a very costly approach because everybody has to do it, with the highest costs going on the poor, unsophisticated consumers that can least bear it.
Yeah.
Another approach is to have some trusted third parties that provide the services, private parties, or that police the bad actors in the form of governments. But it would seem like that could result in a financial world that looks a lot like today.
Absolutely.
So how do you propose we deal with the bad actors and bad practices?
Such a great question. I'm not proposing to do anything. Sadly, we are powerless about the emergent system that's going to come out of this. What I am excited by is a network that allows everybody to participate in the financial system on a first-class basis. I want everybody, including that 16-year-old in Romania, to be able to connect to the financial system with the same connectivity and exactly the same conditions as JP Morgan. That's what really appeals to me. Now, you are absolutely right, and we are seeing this already, that regular people are not going to be able to bear the costs of being their own bank, right? It's very hard to manage your own keys in the same way that it's very hard to secure your own cash. That's why you go and deposit it at a bank. So we will definitely see the emergence of a new class of middlemen. And well, this is why I said it's an extinction level event for certain classes of incumbents, and it's an opportunity for others, because we will have to go from what we had before to a different universe. Now, that different universe does look a lot like it has new intermediaries. That is true, but it's not like we are actually taking a huge step back and we're going back and recreating the exact same universe with exactly the same drawbacks. In particular, the fact that blockchains give us transparency to the back end, the fact that they allow anybody to audit on the blockchain what exactly took place, means that we can actually build new systems where the intermediaries are untrusted. So there is an intermediary, yes. They manage this, that, or the other for me, sure. They collect for example, they collect my yields from my decentralized finance applications. That can happen. But I do not necessarily need to trust them with my assets while they do this. Or it's possible to build this in a way where I can at any time request my assets and get them back. Or I can at any time do an audit of their holdings myself. So these are issues that, sure, the crypto space had problems with some of these before, but we have protocols for some of these where you can, for example, in the way that I cannot go to Charles Schwab and say, do you really have all my stock? I can go to an exchange and say, can you prove that everything that you say you have is actually backed? So there are protocols for doing this, and the underlying technology allows this. That's, I think, what I'm super excited about.
Again, Jacob Leshno has a question. Let me let Jacob talk right now.
Hi, Gun. Great to hear you. Thank you. I actually asked a different question, but following on the previous one, I'm trying to understand whether you actually need as a distributed system. Because if you want transparency, can't you have transparency without having a distributed system? Can't JP Morgan just publish the records using some cryptography? If you want full access, can't you have a centralized system to just provide full access? How do you see decentralization kind of playing a role here?
So that's, again, this is very insightful. So here's what happened. Now I can tell you empirically what happened. About 6 years ago, Ethereum got created, and Ethereum is a smart contract platform. And Ethereum is a decentralized smart contract platform. Since then, there have been a series of systems that have been trying to replicate or go on top of what Ethereum did. Avalanche is one of them, and it's spending a lot of energy to try to be decentralized. And in doing so, it incurs costs, right? Because all these people are part of the system, they need to be incentivized, et cetera, et cetera. Transactions cost something. Meanwhile, we had a company called Binance, which is an exchange, simply take the Ethereum code and they started running it. So it's a centralized version of Ethereum. It's called the Binance Smart Contract Chain. And it has exactly the same auditability. It has exactly the same functionality as Ethereum. So this is exactly what you were suggesting, right? So JP Morgan could do the exact same thing. Goldman Sachs, et cetera. The traditional finance could just embrace and adopt these technologies. The difference here is as long as you have a single entity in charge, then the funds and value on those chains can be usurped unilaterally. So one of the main draws to this space is the fact that, when you're using, let's say, Ethereum or Avalanche, etc., yes, there's a public record of what happened, but it's pseudonymous and there's some amount of privacy on there. There's nobody to, a government couldn't just say, hey, what did Gun do on this blockchain? And a government could also not say, let's take Gun's money from here, like let's tax him or let's usurp his money. So those things cannot happen on a decentralized platform, and they can on these centralized versions of it. So most of the crypto space is staunchly philosophically opposed to these centralized blockchain solutions. They find them to be competitors, and and they find them to be sheep or whatever, wolves in sheep clothing, right? So I'm not like that. I do believe that Binance Smart Contract Chain is better than just Binance, right? Because I can audit it. It provides that transparency. It's a level up. So we left behind the client-server architecture of Binance. We went to a slightly better architecture where there is at least some transparency. That's good. I would never use it, but I'm not staunchly against it. I think these guys should be doing what they're doing. I would not be the least bit surprised if JP Morgan did the exact same thing, and I think that would be fine. It's good for everybody. I would love for corporations to be more transparent about what they do. I think these are all things that improve the state of the world as we have it now to something that's better, that provides better assurance. When I sleep at night, I want to know what's happening with my money. I want to be able to audit my financial institutions. So I think that's a good trend, and I'm not against it. Many others are, but I'm not. And I think the true value will always lie on the decentralized side. So whatever happens in a siloed, small universe, much more will happen on an open infrastructure.
So let me turn to Xavier. You have a question? Let me see if I've been able to. Yes, good.
My question is, so I understand that Avalanche has an interesting consensus mechanism. Maybe we don't have the time to get into it, but my question would be more, what's the key differentiator of Avalanche as an ecosystem? Because I understand that now we have an open market of different algorithms, and I don't think it's necessarily the most important differentiator at the moment, as we see with the Binance Smart Chain, like the reuse existing. So what's your take on that? Like how you see Avalanche playing a role in the current ecosystem?
So I think you're pointing out the fact that there are quantitative and qualitative differences. You need to have both, right? And I agree with you that quantitative differences typically are not big differentiators, right? So if somebody's doing something and I'm 30% better at that, typically that's not a big win. But Avalanche is faster by many orders of magnitude. So, we go from an hour to 1 second, blink of an eye. That's qualitatively different. You can have a website that's backed by Avalanche. You cannot have a website backed by Ethereum or backed by Bitcoin because the delays are so long, like 14 seconds for the first confirmation in Ethereum, 37 minutes for full security on Ethereum, an hour for full security on Bitcoin, 10 minutes for the first confirmation. I mean, these are terrible times. And 1 second for full security on Avalanche is a big deal. So first of all, I would say quantitative differences that are multiple orders of magnitude are huge, like they turn into qualitative differences. In addition to that, though, there are other differentiators. The second big differentiator behind scale and performance is the ability of Avalanche to create subnetworks. So you can create specialized networks with your own virtual machines. So whereas these other coins are typically doing one coin, one scripting language, one virtual machine, Avalanche supports multiple virtual machines and multiple scripting languages. So that allows us to custom tailor solutions for different enterprises. So when you talk to enterprises, they typically say things like, I'd love to have my assets deployed on some chain. I don't want to pay that chain's fees because they can go up and down. Right? People were paying $50 per transaction in Ethereum about a month ago. So if, let's say, Siemens is using Ethereum for its IoT devices, then every single interaction with your IoT device is going to cost $50 and it's out of their control. So that's one big problem for them. Or when there's a bug, they want to understand how it's going to be governed, how it's going to be fixed. And if it's the open public network, they have no control. So there are aspects of control that Avalanche provides by virtue of providing control over the network that nobody else does. So it's a key differentiator and one of the main attractants for enterprises. And the third and final issue is governance. So these, especially the first generation blockchains, baked everything in. And I think if you've ever been in these circles, they're very contentious. Every change creates a big fight. There are all these like really like to the death kind of battles over simple changes to parameters. Bitcoin had one of these over a block size debate, and the entire community split. That was very acrimonious. And this is what happens when you don't have governance built in, and then you have to fight it out elsewhere. But if you do have governance mechanisms built into your system, then you can adapt. And Avalanche does not currently have governance enabled, but it's in our roadmap, and we're about to add that feature sometime very soon. It allows us to change key parameters by voting on chain, so where the stakeholders get a say on how the system should behave. So those are the three big differentiators, and I think they give us a leg up compared to our competitors.
So Gan, I think we're going to have time for one more question. Anusha, you were in the queue. I've clicked to allow you to talk. Do you want to ask your question?
Yes. So I think my question is related to how we think about the intrinsic value for cryptocurrencies, like especially with the rally of Bitcoin. There is still like, I'm just thinking, is this like mania or speculation, or like with so many billions invested into that, what is the, like, you know, the intrinsic value for Bitcoin which would drive these prices up so much? Or is it just like speculation or a bubble building up?
That's an interesting question. One I've pondered myself so many times. What is the intrinsic value of this thing that we're all working on? And, you know, I mean, I'm a computer scientist. I look to you guys, right? What is the intrinsic value of any of these assets we trade? What's the intrinsic value of gold? And people are going to tell you, well, you know, it's used in jewelry, this, that, and the other, but no, not really. You know, the amount that's used in those applications is tiny. So the intrinsic value of Bitcoin and these crypto assets is whatever the crowds place the value at. I think we just have to trust the wisdom of the crowds. And they see great value, it seems, in an asset that cannot be seized, that can be sent over the internet easily, that can be taken with you, that is just essentially yours, no questions asked, and that provides you at least some amount of privacy. So depending on what happens in the world, I think that value will go up and down. I think if people don't have economic anxiety, then probably that value will be lower. When people have economic anxiety like they do now, it ends up going up. Many people will tell you that these are inflation hedges. I think I'm not in econometrics. I think people can study whether or not that claim holds water. From my own sort of layman eyeballing, sometimes Bitcoin is correlated, is anti-correlated with other assets, so it's a good hedge. Sometimes it's fully correlated, so I wouldn't really push that line of reasoning myself, but that's something that many crypto enthusiasts will tell you, that it's an inflation hedge asset. So the value stems from how people's perception of their own economic reality and what they see over here. But on top of this, let me add the DeFi component. There is great value in DeFi. You can do things with DeFi that bring new value to the world. So a lot of, it seems like this is a contained universe, right? But it's kind of not. You can end up using these DeFi platforms for taking loans out. So suddenly, it's an open-ended universe with ties to a much richer ecosystem. So I can take loans out from, say, the Avalanche ecosystem or the Ethereum ecosystem, use it for something, and then bring back new value into the chain. And so that means that the amount of value is it's not, how to say this. So typically a self-contained universe, you can, it's a zero-sum universe. The fact that I can do lending means that we can actually generate new value and bring that in. In the same sense, I don't want to draw on this analogy too far, but in a similar sense to how stock, corresponds to future earnings of companies, the money here can be used for positive, productive economic activity and can bring new value in. So especially these lending coins tap into a different kind of a money flow. And so that adds additional value besides just these assets are what they are. So so that's an interesting world. And deep down, I think everybody kind of realizes that money has as much value as we place in it. It's just a collective, collective belief. It represents the collective belief of value in that ecosystem behind it. So so I'm excited about where we are. I couldn't tell you whether we're undervalued, overvalued, etc. I believe it's going to grow. I believe it's going to grow substantially, because it is tapping into a whole lot of different areas, and it does represent a new direction for infrastructure, for Wall Street infrastructure that's better than the current direction they're on. And there are, the trends are very hard to counteract. So I'm excited. I think it's going to grow. I think it's undervalued if you ask me, but I couldn't tell you what the intrinsic thing is. That's for the market to determine.
Well, Gun, thank you very much. Before I wrap up and thank our speaker, those of you who are unable to get your questions in, I'm sorry, but if you want to continue discussions and learn more about all of this, we are having our CBER conference on April 16th and 17th. If you're not familiar with that, you should head to www.cber-forum.org/conference and learn about it. We're very excited about the papers that are going to be presented there. But I would like very much to thank our speaker today, Gun Sewer. I find Gun to be, I always enjoy talking and listening to Gun because he certainly has a perspective on the markets that, on these new crypto markets and new directions that are difficult for us in finance. So thank you very much, Gun, for joining us, and thanks everybody else for joining us today too. And I think we'll end it at that today. So bye, everybody.
Thank you so much for an insightful discussion.